So we're going to get right into it and get through the intro and the disclaimer. Good afternoon, everybody. Welcome to our May 2022 webinar. For those of you who are new to joining us, my name is Lorenzo Pederzani. I'm one of the portfolio managers on the team. With me is Matthew Evans, one of the other portfolio managers, and Joe Bast, one of our associate portfolio managers out of our Qualcomm office. Today, we're going to be talking about the markets. And no doubt many of you have looked at your statements in the last month or two and noticed that they are down in value. We have seen a pretty volatile market environment since November. And so we're going to try to provide a little bit of context today about, what's been going on in the markets, as well as, what has been working really well for us in the portfolio and where the opportunity sets that we see are, and what we're excited about here, going forwards. We always like to pick a quote every month, and today's quote comes to us from Warren Buffett, which we think is particularly suitable for today, which is, investing is simple but not easy. Certainly staying invested in times like this requires a little bit of fortitude from all of us. So we'll start off with some disclosures and disclaimers. Everything that you see here today has been prepared by Matthew Evans and I. We believe that the information here is reliable and accurate, but we cannot guarantee that accuracy. Everything that we talk about is based on kind of our analysis, and we think is valid as of today's date, and there's currently no plans to update it in the future. What you hear today is not any form of solicitation for you to buy or sell any securities. It is simply presented for informational purposes. We do talk about alternative investments in the presentation, and I want to be clear that alternative investments are not suitable for all investors. You should absolutely seek advice from a professional to make sure that they're right for you. And then just a quick note on forward-looking statements. Forward-looking statements are essentially statements that talk about that often people who are making presentations like us will talk about what we think will happen or what may happen or what we anticipate happening. It's important to understand that these are just speculations or ideas and not necessarily things that are anchored in fact at this point, and we don't know what's going to happen obviously in the future. Lastly, Westmount Wealth Management is a registered portfolio manager in BC, Alberta, and Ontario. All right, let's get right into today. Matt, what has been going on in the markets?
Well, we are 4 months into 2022, and it's turning out to be one of the most challenging starts to a year in decades. It's not really the depth of the declines that we're seeing here with the red arrows. It's rather the inability to diverse away some of that risk in a traditional balanced portfolio. So what I mean by that is that traditional balanced portfolio contains both stocks and bonds. And as you can see, both of those are down year to date.
So just to touch a little bit on what Matt was saying, this is a slide that you've all seen. It's part of our investment philosophy. We've been talking about this for at least 3 years. And I'm going to get you to concentrate on the second point, which is increasing correlations. This is something that we're seeing right now. So when asset classes are correlated, it just means that they're doing the same thing at the same time. And as Matt was explaining, the depth of the assets going down at this point is not that great. But it's the fact that stocks and bonds are both going down together at the same time that we're kind of feeling it. And so this is something that we've been talking about, as I said, for years. And it's part of our investment philosophy, why we want to have that exposure to another asset class that is not going to behave the same. And of course, that's the private investing that we're going to be talking about today. So Matt, maybe you can tell us a little bit more about what's going on. Why is the market pulling back?
Yeah, I'd like to take some time to provide some context to why things are the way they are right now. And there's really 4 major interconnected reasons why. We've got global growth slowing down. And I don't know if you've read any of the headlines recently, but we have upwards of 300 million Chinese citizens in a lockdown because of a COVID outbreak. And China, as an economy, represents about 18% of world global GDP. So if China slows down, it's going to have a trickle-on effect across the global economy. Also, the fact that they're generating about 15% of the world global exports. So as a consumer on the opposite side, if China slows down, so does the world. That's also trickling into inflation. So We've got supply chain issues that started because of COVID, but are now exacerbated because of this lockdown. And we're all seeing that today. You've probably paid more than $2 a liter at the pump, or you can see it actually at the grocery store. So to combat this inflation, central banks globally, mostly in North America, have started to increase interest rates. And they do that to slow down the economy because we've got some overheated sectors right now. Further to that, we've got the war that has continued with Russia and Ukraine, which is also creating more inflation pressure in this current environment. So all four of those ideas are really adding to where we are today. So I've kind of given some context to why things are happening, but I think most of the clients on the line really want to know, well, what are we going to do about that? So Lorenzo, could you provide some context for that?
Sure. I'll answer this question in two ways. The first thing I'll say is that in the traditional sense, we're doing nothing. What does that mean? We're doing nothing. It means that traditionally in a down market, you've got two levers. You've got your stocks and your bonds. As your stocks drop in value, like they did in 2020, between February and March, what we did is we sold some of our bonds, which had, still held their value or gone up in value, and then purchased more of the asset class that had suffered the most, your stocks. So traditionally, that's what we do. And we tweaked portfolios about 9 times for clients in 2020 as a result. Right now, we're in a very unusual circumstance. As Matt showed us a few slides ago, you've got, I'll just pull it up just to kind of highlight the numbers. You've got bonds, and this is data as of a few days ago. You've got bonds down 10%. That is a massive, massive loss for traditional bonds. While stocks are down, significantly as well, double digits. So in a situation where both your stocks and bonds are down, there's no really point to rebalancing because we feel that both those asset classes are probably pretty oversold at this point. The second part of the question, though, it relates more to this whole transition. And a really big part of why we decided to go through all the effort of launching our own firm was to be able to offer clients more exposure to high quality institutional grade alternative investments and diversify some of the equity exposure and some of the bond exposure. And most of you on the line here, just looking at the names, have been rebalanced over the last few months into our two models. And so we've been taking some of what would have been, a 60%, let's say, in a balanced portfolio allocation to equities, and redirecting, some of that, let's say 12% in a balanced portfolio setting to alternative equities and so on. So that's really the goal. Sorry, 18%. So that's what the goal of what's been going on. And you, as I think you will see here in a few slides, the losses that a lot of our clients have experienced are probably less than they would if they'd just been in a stock bond portfolio because of the fact that we've had a fair bit of exposure to alternative asset classes for them. Most of our clients are anywhere from our conservative to our growth portfolio, and you'll have anywhere from a 20 to a 47% exposure to alternative investments. So, Matt, do you want to let us peek under the hood a little bit and explain what's been going on both performance-wise and holdings-wise in each of the two funds?
Sure. So the first fund we're going to touch on is a Westmount Alternative Income Fund. This is where we've taken some of that exposure that would have normally gone to bonds and placed it in the Westmount Alternative Income Fund. The goal here is to remove it from bonds, which may perform poorly as rates move higher, and put it towards assets or holdings that will do well when those rates go up. So just like we did during COVID, when you get volatility in the market, that creates an opportunity for great pricing for structured notes. So as you can see here, as of March 31st, we have 4 structured notes currently in our Westmount Alternative Income Fund. And you can see they're paying yields from 6.4 all the way to upwards of 10.5%. I've subsequently purchased 2 more notes in the pool. And the goal is to purchase a new structured note each month so that 1 year from January, we will have a note maturing each month. And that'll provide a nice healthy yield for this alternative income fund. I just want to also point out some of the legacy holdings that we all are familiar with: Antrim Balance Mortgage Fund and Trez Capital Prime Trust, which you held at your account level previously. We still hold an allocation to those, and we still really do like mortgage investment corps. If you think about it, we're lending our money out in the form of a mortgage, and as rates increase, so do mortgage rates. And you've probably, anyone with a mortgage on the line probably knows that. But as investors in those mortgages, we benefit from higher rates. So as rates move higher, well, we hope that our mortgage investment corps pay us a little bit of a higher yield. So that's kind of a highlight of what's happening in that Westmount Alternative Income Fund.
And if I could just highlight one thing really quickly, we saw some of the bond return data a few slides ago. Now that bond data is up till the end of April. We're a few days away from giving the end of April price because our alternative funds are priced monthly, but up until the end of March, all three of the bond indexes were down a high 6%, so almost 7%. This fund was down only less than 1%. So again, obviously we would have wished to be in positive territory, but down 7 versus down 1% is a very big difference. So we feel that this fund has done exactly what we wanted it to do, which is protect in a rising rate environment.
So the next fund that we run is the Westmount Real Asset Fund. So this is a position that holds infrastructure and real estate. And as you can see, the first quarter returns were exceptional. This fund produced a rate of return of 5.24%. That really shows the diversification, like Lorenzo just mentioned, of owning these private assets. So I'm just going to highlight where some of that performance attribution came from. One of the positions we have in there is this Manulife Canadian Real Estate Investment Fund. It holds 61 buildings across Canada, and a large concentration of those buildings are industrial warehouses. And I don't know if any of you on the line read that recent Vancouver Sun article about the vacancy rates in Vancouver warehouses being less than 1%. It is so hard to find space that they've been shipping goods out of Vancouver all the way east to Calgary to hold them before they get shipped back to Vancouver. So you think about that. That leads to industrial rents soaring and land value soaring. So the Manulife Canadian Real Estate Fund that holds a large chunk of its assets in industrial warehouses produced an 8.8% rate of return for the first quarter. So an exceptional position for us. Another one that I want to highlight, one that we're all familiar with, Rise Properties Trust. I'm going to highlight it because they just hit their 10-year number. So they've been managing the 6,200 apartments down in the Seattle and Portland area for 10 years, and the compound rate of return is just north of 14% per year. So we really like this Westmount Real Asset Fund. We feel that it'll be a strong diversifier against these equity and fixed income or bond volatility. And it's a nice way to help diversify our clients.
I just want to clarify one point. I see Kim made a comment here. Do I have enough money to get into these funds? To be clear, if we've rebalanced your accounts since you've come over, you're already holding these two funds. Alternative income is the Westmount Alternative Income Fund. So if you're a balanced investor, you would already have a 12% weight in it. And if you're that same balanced investor, the real estate infrastructure is the Westmount Real Asset Fund. You already hold a 17% weight in it. So if you've been rebalanced, you already hold these two funds.
The next part of this presentation, we thought it would be a good idea to answer some of the questions that we've seen come in over the quarter, because we know that if certain clients are thinking about it, maybe many of you on the line are thinking the same thing. So I'm just going to start this off, Lorenzo. I've heard some questions about our investment portfolios are going down as soon as you set up Westmount and transitioned our accounts. Did something happen?
I'm sure it's something that is in people's minds. To be clear, we've been planning this transition for 2 years, and it just so happened that all of the stars aligned for us to begin that transition after everything put in place in November. Just within the week that we started, effectively, the market started to wobble a bit, predominantly based on fears over rising rates. And so, no, it's just an unfortunate luck of the timing. But, I would also say, I think that the market volatility that we've seen in the last 6 months has really reinforced our thesis that we have further, moved into. If we'd just been sitting in our traditional bond and stock allocation for client portfolios would probably be down another 2 to 4% relative to where they are. Those alternative assets have really helped protect clients.
So just to touch a little bit on what Lorenzo was saying, we're just going to show you a couple of examples of really well-known mutual funds. So Mauer Balance, a very well-known Canadian mutual fund. So it's a balance, 60 stock, 40 bonds. As you can see here highlighted, this is as of May 2nd, year to date down 12%. Another fund we're highlighting, and we're not picking on any of these companies, it's just to give a little bit of a survey. RBC Select Balance, we're looking at this mutual fund because it's actually the largest mutual fund in Canada, just shy of $50 billion in this fund, okay? And not surprising, RBC is obviously, a very large bank in Canada. Year to date, down a little over 10% as of May 2nd. And then this last one, we chose it because of the name, TD Comfort Conservative Income. I mean, that sounds wonderful. Who wouldn't like some comfortable conservative income? I'm sure that's a very nice, smooth ride. Again, just like all other kind of balanced funds, down 10% year to date. So we're just giving a little bit of a survey there to show what's happening. Now, another question. So I'll ask this to Lorenzo. If we knew that inflation was going to be a problem and that central banks would be increasing rates to combat that, and we know that increasing rates is going to impact bonds negatively, well, why hold any bonds at all?
That's a very common question we get, Joe. Ultimately, we feel strongly that a well-diversified portfolio sits on a number of building blocks. And one of the core building blocks to protecting a portfolio, insurance, if you will, are investment-grade bonds. That doesn't mean that investment-grade bonds are always going to be making money, but it means that very often when things get ugly in the equity markets, they're there to protect us. Obviously, we're in a very unusual circumstance where we're seeing the worst 4 months for bonds in 30, 40, 50 years, apparently. But that if you look back just 2 years ago to February and March of 2020, when stock markets were down 30 to 40%, it's the bonds were a big part, that and the alternative investments that we already had for clients back in the day that helped our model portfolio stay rather buoyant. So the key is not, for most of our clients, whether to hold bonds or not. It's more of a discussion of how much to hold. And we feel philosophically that the traditional 60-40 needs to be evolved a little bit more to holding more alternative investments. So instead of holding just 40% in bonds, perhaps we're holding a lower percentage and moving some of that to other forms of fixed income. And that's what we've done for clients. We can skip this. Oh, sorry, Joe. So another question we've been getting is, wouldn't it be better if things are volatile right now to sit things out, sell to cash, and wait until the markets calm down a bit?
So we're going to answer emphatically no, and the reason being we've discussed this many times. We do not want to be timing markets, okay? Because market timing has been shown to be consistently a losing investment strategy. It's in theory, it's alluring, but it can't work, and it's akin to gambling. Yes, we do trim, or we can make little changes in our asset allocation slowly over time, but we don't want to be reacting to market events because that's an emotional based trading strategy. So looking at this chart, what you can see here, the green are periods where we call bull markets, right? Markets are rising. And in that blue is bear markets, okay? And what you'll notice in looking at this chart is that, well, first of all, bear markets or markets declining in value are a natural part of the cycle, right? They come with some period, they come once in a while, but what you will notice is that they're often shorter in duration and they can be quite volatile, Okay, so you can't have one without the other, and it's best to just sit through these periods. This is just an interesting slide. If you look at the orange bar there, you can see the average investor over the last 20 years has averaged 2.9%. Okay, so a lot worse than some of the other asset allocations. And again, the number one reason being that if you're not getting good advice, if you have an emotional-based trading strategy, what's going to happen when the market gets a little scary? You're going to react and you're going to sell, right? And we have to allow the magic of compounding to work uninterrupted. So it's very important to keep that in mind, especially during these types of periods.
The other thing I always like to add to that is that, you know, even though it's very comforting to think, okay, I can take control and get off the roller coaster, the much more difficult decision then begins the second you sell everything, which is, when do I get back in? If the markets are down 10%, you know, let's say like they might be now, market might is down 10%, and you decide that's not that, I don't feel comfortable with that. Now let's say the market drops another 5% and the markets are down 15%. If you were the person that were uncomfortable when the markets were down 10%, what do you think the headlines are saying when the markets are down 15%? Would you be comfortable getting back in, you know, timing the bottom? Very, very low probability that that would happen. Similarly, now let's say the markets calm down, and we know that when markets rebound, sometimes they rebound very quickly, or that the first few snapbacks can be very quick. You miss that, now the market's up, you know, 10, 15%. Do you feel comfortable now getting back in at that point? Or do you think to yourself, well, I missed the rebound, I'm just going to wait for the next dip? How long is that dip going to take? Is that dip going to be lower than the current position? So there's a famous expression in investing that, you know, markets can remain irrational longer than you can stay solvent. And so it's important not to try and think you can outsmart the markets, because in the short term, markets are not rational. So, Matt, what can you tell us a little bit about what we've done in the portfolio year to date?
So I'm going to go over some of the purchases we made over the last 4 months in the Westmount Alternative Income Fund first. Two of these I alluded to earlier on. We did structure 2 new structured notes, the first being issued by CIBC, and it's based on the Canadian stock market. And the way that this note works is we're going to take a look at the Canadian stock market 1 year from April. So starting in April 2023, we're going to take a look at the Canadian stock market. If it is the same price as it was 1 year prior or better on that observation date, we are going to get our capital back plus a stated rate of return of 10.6%. If, though, the market is not up, so that means the Canadian market is down 1 year from April, we would do the same thing again. So we would look at the indice. If it is in April 2024 positive or the same price, now we're going to get our capital back, but we're going to receive 21.2%, and that can happen every year for 7 years. So it's a nice way for us to use this volatility to pick up some nice yield for our alternative income fund if or when that note gets called. To counterbalance that note, because that has the opportunity to get called once a month, we've combined it with a monthly income note issued by by National Bank. This one, the underlying reference asset is the Canadian banks. And as long as the Canadian banks trade in a range of -30 to +5 on each monthly observation date, we will receive an interest payment of 0.7%. That works out to about 8.4% per year. So as long as the Canadian banks are trading within that range, trading sideways like they are right now or slightly down, we're going to continue to receive that income payment. At any point that they trade above that +5 on a monthly observation date, same thing as the note above, we're getting called, we're getting our principal back, and the note is done. So I've laddered these notes every single month so as to harvest some of this volatility that we've seen in the market, and we'll continue to do so as we get more cash flows into the Westmount Alternative Income Fund. So a nice way to take advantage of the volatility in the market right now. The last one I'm going to highlight is Neighborhood Holdings. This is a new mortgage investment corp that we are using to diversify our two existing mix in Antrim and Trez. So neighborhood is very similar in nature. It is a portfolio of first mortgages across Canada on residential homes. Fund itself is about $345 million, and the average mortgage is quite small, and that's what we want to see. It's widely diversified, about $375,000 per mortgage. Since inception, it's done a net rate of return just shy of 8%. So a nice way to diversify the two existing mix that we have, which brings the total portfolio to about 2,900 individual mortgages. So again, it's all about diversification. Next, we're just going to highlight some of the two new exciting positions that we have in the real asset fund. If anyone was on our webinar last month, they were lucky to hear Dennis Mitchell talk about the Starlight Private Global Infrastructure Pool. Very exciting, and has some neat investments held in cell phone towers, data centers, toll roads, solar farms. And then we've paired that together with the Mackenzie Northleaf Private Infrastructure Fund. Very similar in nature, just again, diversifying those assets outside of Canada and the United States. So a little more global exposure there. And again, it's all about diversification. I would like to say private investing or alternative investing isn't that silver bullet. Really what we're trying to do here is just diversify our income stream and diversify our returns. So when your stocks and bonds aren't working out, at least, or you may have another investment asset class that is working for you. So